Okay, so we're going to continue with chapter 11 today. Section 11.3 is sinking funds, finding annuity payments. So the objective is understand the basics of sinking funds and set up a sinking fund table. So a sinking fund is a fund set up to receive periodic payments. Sinking funds are used to provide money to pay off a loan in one lump sum or to accumulate money to build new factories, buy equipment, and so on. The payment needed at the end of each period to accumulate a fixed amount in a sinking fund at a specific future date is found as follows. So you're going to take the payment is going to equal future value times the number from the sinking fund table. Again, this sinking fund table should be printed out, or if you want, I guess you could save a copy onto your computer, but my eyes need it printed at this point. So here's one a little bit closer up. It's a little bit nicer for your eyes. So example 1 here says, in 5 years, hospital administrators plan to erect a building that includes a gym, a swimming pool that can be used for therapy at a cost of $16,500,000. To prepare for the expense, they decide to make end of quarter deposits into a sinking fund expected to earn 6% compounded quarterly. Find A, the amount of each quarterly payment, and B, the interest earned. So for A, we're going to use 6% divided by 4, which is 1.5% per compounding period, and 4 times 5 will give us 20. From the table, so you're going to go 1.5% down to 20. So that should be 0.04325. Well, look at that. We were right. Excuse me. That just showed it to you a little bit closer up. All right, from the table, we get 0.04325. So quarterly payments, you're going to take the principal or the future payment, future goal, future value times the number from the table. So they need to make quarterly payments of $713,625. And then if they do that, they will get a total of 16,501,629 at the end of the 20 end of quarter payments with 6% compounded quarterly. Interest is future value minus payments. So the future value minus the number of payments. So their interest alone is amazing. 2,229,129. Okay, and what's nice about that, though, or I guess what isn't so nice about it, is because it's kind of like a sinking fund. You're putting a lot of money into it, and then you're gonna turn around and spend it all. So it's not like you're really getting a lot out of it. You just don't have to make those payments up front or anything like that, or ask for a big loan and then have to turn around and pay a whole bunch of interest on the loan. All right. Find First Christian Church sold $100,000 worth of bonds that must be paid off in 8 years. It sets up a sinking fund to accumulate the necessary $100,000 to pay off the debt. Find the amount of each payment into a sinking fund if the payments are made at the end of each year and the fund earns $10,000 compounded annually. Find the amount of interest earned. From the table, 10% along the top, 8 periods down, the side yields 0.08744. So payment is equal to 100,000 times that amount, which is $8,744. And then to figure out the interest, you take the 100,000 times the 8 times the payment, and you're going to get an interest of $30,048. Okay. Setting up a sinking fund table. A sinking fund table is used to show the interest earned and the accumulated amount of a sinking fund at the end of each period. I won't lie to you, this was a little bit fun for me in the homework. It might make me sound like a dork, but I really enjoyed doing this. It was kind of frustrating at first when you didn't really know what they wanted, but obviously you guys have an example, so you'll have it a little bit easier of a time than I did. So First Christian Church in the previous example deposited $8,744 at the end of each year for 8 years into a sinking fund that earned 10% compounded annually. Set up a sinking fund table for these deposits. After each calculation, round each answer to the nearest cent before proceeding. Year 1, deposit made at the end of the year, no interest earned. The total is $8,744. So then there was a 10% interest, which is $874.40. So that total is now going to be the 8,744 plus the 874.40 plus another 8,744 to make the end of year 2 $18,362 and 40s. Oh, sorry guys. So continue this work to get the table. Last payment is for $4.60 more to get exactly $100,000. So here's their whole table. Yours is not going to look like that exactly. Okay. All right. Okay, managers at Baton Chemicals frequently travel between the corporate offices in the United States and manufacturing plants and mines in South America. They plan to purchase a private jet in 4 years. The jet costs $14,800,000 today, and its cost is expected to grow at 5% per year. Find the quarterly payments needed to accumulate the necessary funds in a sinking fund in 4 years if the firm earns 6% compounded quarterly. So it says, first find the cost or future value of the jet in 4 years. So you're going to take 5% per year, 4 compounding periods, table yields 1.21551. So the future cost of the jet will be $17,989,548. Next, it says find the quarterly payment needed to accumulate that much in 4 years. So you're going to take 6% divided by 4, get you your 1.5% per quarter, and 4 times 4 will be your 16 compounding periods. So your table yields 0.05577. So your quarterly payments will be $1,003,277.09. Again, it must be nice to be a company and not a people. This is the last slide on 11.3. We are going to move on to 11.4. Okay, stocks and annual mutual funds. Learn the basics about stocks, read stock tables, find the current yield on a stock, find the stock's PE ratio, define 3 common stock indexes, and define a mutual funds and exchange traded funds. So, corporations, publicly held corporations owned by the public, their stocks are traded daily in markets called the stock markets. So the biggest one, of course, is in New York. But I mean, there are other ones all over. They're just not as well known. Probably not as crazy either. Privately held corporations owned by one or a few individuals, and their stock is not traded on a market. Limited liability laws protect stockholders from lawsuits, and owners never lose more than they have invested. Capital, money raised through the sale of shares of stocks. Stock is a share of stock is partial ownership of a corporation. Stock certificate, proof of ownership. An annual meeting required of corporations open to all stockholders. Board of directors, elected group of people who represent the stockholders. Executive officers hired by the board of directors, president, vice president, etc. Dividends, regular payments to stockholders representing a portion of any profits. Preferred stock, have certain rights over common stockholders, paid dividends before common stockholders. Common stocks, less rights than preferred stockholders. Publicly held corporations, typically owned by many different individuals and institutions. Share prices determined by supply and demand in public markets called stock exchanges. New York Stock Exchange is the largest in the US. So daily stock prices are readily found in many places on the internet, such as finance.yahoo.com or WSJ.com. Information on the stock of many widely held companies such as Apple or Nike is also found in a weekly financial magazine, Barron's. Here's our first example. After receiving his first paycheck, Daryl Johnson went to Best Buy to look at iPhones and MP3 players. He liked the company so well that he decided to do some research on it, analyze information about Best Buy and stock given in the table. So high, low for 52-week, name, tick symbol, volume, yield, PE, weeks last, change, latest year, this year, next year, dividend amount. Okay. So at the highest price at which the stock was sold during the year was $49.40. The lowest price at which the stock was sold during the year was $25.31. And the ticker symbol under which the stock trades on the market is BBY. This will definitely be on your next exam, I'm pretty sure. The volume of shares sold during the day was 100 times 242901, which gives you 24,290,100 shares. The current annual dividend was 2.4% on the current stock price. The ratio of stock price to earnings was 14. So that's that PE. And the stock closed at $47 per share at the end of the week. So everything that was just done here, and I believe the statement on the next slide, that's going to be on your Chapter 11 quiz. So your minor quiz for Chapter 11. So definitely this set of slides is something you'll want to write down and reference when you go to that. I think there's like 2 or 3 questions about it. All right, the price of the stock was down $2 compared to the close at the end of the prior week. Best Buy earned $2.56 per share last year. It is expected to earn $3.26 per share this year and $3.47 per share next year. The most recent dividend was $28 per share. We know it is quarterly divided, since the total annual dividend 1.12 equates to a 2.4% annual dividend yield noted in E. All right, trading stocks. Individual stocks can be purchased using stockbrokers or individuals who make their living by advising investors. Stocks can also be purchased directly by individuals through any of the numerous discount brokers, such as Schwab or Fidelity, in a process similar to buying something on Amazon. So example 2, ignoring commissions, find the cost for each of the following purchases. Use data in the stock table on page 435 in your textbook. 500 shares of Bank of America at the close of the week. 500 shares times 2266 is 11,330. 800 shares of Baldex, BLX, at the low for the year is 1963 times the 800 shares is 15,704. Then find the combined annual dividend from these two investments. So quarter dividend for Bank of America was 75 or 0.075 times 500 at 37.50. Quarterly dividend for Baldex is 0.385 times 800, which is $308. So together, that's $345.50, and we divide that by 4 and get 1,382. Okay. Choosing stocks, 2 stock ratios that people examine before buying shares of a company. Current yield shown in the table as YLD. Price earnings ratio shown on the table as P/E. So current yield is the annual dividend per share divided by the closing price per share. Use data in the stock table on page 436 in your textbook to estimate the current yield for Bankrate and Barclays BCS rounded to the nearest 0.1%. So you divide 0 by 10.35 and you get 0%. And you divide, or you have to multiply 0.0528 times 4 and divide it by 1129 and you get 1.9% for the second one. The PE ratio is closing price per share divided by annual net income per share. So we're going to find the PE ratio for the following corporations and round to the nearest whole number. Apple Inc., AAPL, with a closing price of $116.52 and earnings of $8.31. You're going to divide those two and get a PE of 14. And then Nike, NKE, with a closing price of $51.91 and earnings of $2.22. You're going to divide those and get a 23. So define the Dow Jones Industrial Average and the NASDAQ Composite Index. So the Dow Jones Industrial Average is based on the prices of the stocks of 30 very large firms that trade on the New York Stock Exchange, including ExxonMobil, General Electric, and Boeing. Standard & Poor's 500 based on the prices of stocks of 500 large firms that trade on either the New York or the NASDAQ Stock Exchange, including Apple, Amazon, and Chevron. NASDAQ Composite Index is based on the prices of many firms that trade on the NASDAQ Stock Exchange, including mostly technology companies such as Apple, Facebook, and Twitter. Okay, so they have a diagram there for you. Notice how people just didn't have the time or money or energy or effort to do the stock stuff years and years ago. All right. Mutual fund receives money from many different investors and purchases stocks or bonds in many different companies, usually actively managed. Exchange-traded funds, similar to mutual funds, tend not to be actively managed, low-cost way to purchase a portfolio with some diversification. All right, here's our next example. Cynthia Peck wants to know whether she should invest her retirement monies in certificates of deposit, remember those are CDs, or in a mutual fund containing stock. Assume payments of $2,000 per year for 30 years, and a certificate of deposit paying 4% compounded annually, or B, a mutual fund containing stock that has a returned 8% per year. Find the future value for both and compare the two investments. Use 4% per year for 30 years, and the table yields 56.08494. So the future value will be 2,000 times the amount from the table and you get $112,169.88. So if we use 8% per year for 30 years, the table yields 113.28321. So the future value times the 2,000 and then from the table, you'll get 226,566.42. So the difference there is 114,396.54. So the stock yields more, but they do have a higher risk. Cynthia Peck will need to decide how much risk she is willing to accept before making a decision. I can tell you straight up that I would go with the CD because I would love to even have $100,000. I would not risk the chance of not getting that guaranteed money, but that's just me. Note, the 4% on the CD nor the 8% on the mutual fund is guaranteed for 30 years. Stocks may do better or worse than the bank deposits in 1 year, but stocks tend to have higher returns over the long time periods required for retirement planning. Okay, I can tell you that my parents were in a similar situation. They hit retirement after COVID. So, for a minute there, things were really scary, but they stuck through it and they're doing pretty okay now. So that's that insider's trader trick. Okay, let's wrap this up. 11.5 bonds. Define the basics of bonds, read bond tables, find the commission charge on bonds and the cost of bonds, and understand how mutual funds containing bonds are used for monthly income. All right, so bonds are loans to firms consisting of legally binding contracts between the lenders and the borrowers. They often require interest payments every year and repayment at a specific date in the future. Unlike shareholders, bondholders do not own part of the corporation. Countries, cities, and even churches also borrow money using bonds. So here's a nice little flow chart. Methods managers use to raise funds, corporate profits, sell ownership, borrow, bank loans, investor loans. Coupon rate, the interest rate stated on the bond. Face value, the amount to be repaid when the loan matures. Corporate bonds usually have a face value of $1,000. Face value is sometimes referred to as maturity value or par value. Interest is found using the face value of the bond, usually $1,000, the coupon rate, and the compounding period. Most bonds require interest to be paid every 6 months. The issuer is the corporation or organization that is making the loan and selling the bond. Maturity date at which the bond matures and the issuer repays the face value to the current owner of the bond. The length of time until the bond matures. Terms on individual bonds are determined before the bond is issued, but the terms are often in the range of 1 to 30 years. Bankrupt companies can no longer meet its financial obligations to suppliers, banks, bondholders, and others. Complex process involving management, creditors, lawyers, and courts. Bankruptcy lawyers are paid first. Remaining assets are then used to pay off debt, including bonds. Shareholders do not receive anything unless there are assets remaining after all debts have been paid. Shareholders often receive very little or nothing from a bankruptcy. Bondholders often receive only a few cents on every dollar originally loaned. Face value or par value is the original amount of money borrowed by a company. Principal and other interest due must be paid when the bond matures. Maturity date that the bond payment, principal plus interest is due. Bonds can be sold before maturity date for a price determined by market conditions and credit history of the firm. So here's an example. Brandy Barrett was an automobile accident that put her in the hospital for 3 weeks and required months of rehabilitation. The other driver was at fault, and his insurance company paid Barrett the liability limits on his policy of $50,000. Barrett needs monthly income and is thinking of investing the funds in Wells Fargo bonds that mature in 2046. Analyze the table in the data. I would not do anything with Wells Fargo if I were you guys. The ticket symbol for Wells Fargo is WFC. The annual interest paid per bond is 4.75% of 1,000 face value, which is $47.50. The bond matures on December 7th, 2046, when Wells Fargo must repay the $1,000 face value to the owner of the bond. Okay. The last price at which the bond traded for the day was 99.004% on the face value of 1,000. So the price would be 990.04. An investor holding the bond until maturity would earn 4.813% per year on the investment. This is often called the yield to maturity. The estimated face value of all the Wells Fargo bonds that sold during the week was the volume 171,626,000. So again, I don't know. I mean, I guess I just don't feel like Wells Fargo is something good to put into, but that's me. All right, find the estimated value sold and the last sale price of the following bonds. Use the table in the text on page 445. So Oracle, ORCL, maturing in 2021, Apple, AAPL, maturing in 2046, and Ford Motor Company, F, maturing in 2046. So here's our volumes and the last sale price. Okay, the cost of buying and selling bonds has fallen sharply due to competition among brokers, and it varies widely depending on the volume of bonds being sold or bought. A common charge to buy or sell a few bonds is $1 per bond, but commissions are much lower for large transactions. Find the commission charge on bonds and cost of bonds. The effective interest rate is not the same as the last yield. The last yield takes into consideration the cost of the bond, the maturity value of the bond, the time to maturity, and all interest payments. So assume that the sales charge is $1 per bond. Find the following Kraft Heinz Food Corporation, KHC, maturing in 2026. The total cost of purchasing 20 bonds, which would be total cost equals price divided by bond plus sales charge times the number of bonds. The total annual interest paid on these bonds, which is coupon rate times par value times the number of bonds. So there you can see they were already figuring that part out. And here they figured this one out too. So go ahead and write that down. All right, the effective interest rate to the buyer, including the cost of buying the bonds, would be the 600 divided by the total cost of the bonds, which is 3.2%. Understand how mutual funds containing bonds are used for monthly income. Many planners recommend that people invest in both stocks and bonds. Stocks may be a better investment when investors are young, since stocks have tended to have higher return. Bonds may be a better investment for investors close to retirement, since there is less risk of losing principal in bonds, and bonds pay regular interest. Physicians have told Brandy Barrett in example 1 that she may have long-lasting effects from the car accident. She puts the $50,000 received from the insurance company into a mutual fund containing bonds, since there is less risk than the investing in the bond of one company. Find her annual income if the fund yields 6.5% per year. How much would Barrett need to invest in the fund to earn $10,000 per year? So use the simple interest formula, 50 times 0.065, and you get 3,250. Again, use the formula for simple interest, but now the principal is unknown. Divide both sides by the RT to find the following equation. And get 153,846.15. Okay. So the thing I don't like about these examples is they don't really give you any kind of closure. You have no idea what that woman's going to do. But, we have their random answers that they wanted. All right. So that basically wraps up chapter 11. If you guys have any questions on it, feel free to email me or ask me questions during the next class time. Hope everybody has a great weekend, and I will see you on Tuesday.